I want to welcome everybody to this CAMPS event. Welcome to the tax and regulatory update. We look forward to doing this annually to give manufacturers the things that they need to know. And we will be recording this. So I'd like to introduce our moderator today. Debbie is a highly skilled business in the business aspect of talent management, including coaching, leadership development, facilitation, and organizational program management. Her passion and expertise are to consult with and coach CEOs and corporate leaders, as well as to create and facilitate programs to develop courageous emerging leaders. And I really like that. Before starting SuccessView Coaching and Consulting and Coaching Group, she was on the executive team of an emerging technology services firm where she assisted in growing the business from a startup to a global public company. She is a graduate of the ICF accredited Newfield Network Ontological and Somatic Coaching Program, and she's an enhanced narrative coach practitioner and certified Dare to Lead facilitator. And what I know is that Debbie has just been an awesome member of CAMPS, just great in her participation and willingness to help us. And so Debbie, I want to thank you for being here and moderating today.
Wow, thank you, Kirk. That's awesome. I feel really honored to be here. And I'm excited to introduce today's speakers. We have three very accomplished panelists, and they'll be providing us with the latest tax and regulatory information. And sometimes people think that's boring, but you know, as a business owner, I know how important all of that is, really. And I'm fascinated by it. So I'm really looking forward to the program. We're going to present the program in three segments. So each speaker will talk about their specialty and then answer questions for a few minutes before we go on to the next speaker. Because of that, we're going to be using the chat for Q&A. Let's see. And I just see, I'm going to be managing this in a minute, but somebody already asked if they could have a copy of your PowerPoints. So be thinking about that. You don't have to answer that right now. You can answer that when you're presenting if you'd like. Again, we'll introduce the speaker. They'll tell you some information. And while they're speaking, if a question comes up, put it in the chat or the Q&A, and I will grab those and ask the speaker about it at the end of their presentation. Then once everyone has talked, we'll come back and wrap up with any additional questions. So let's get started. Our first presenter is Nicole Wright, and Nikki, as she goes by, is in the Seattle office of MHM, which is an independent CPA firm associated with CBIZ and a top 10 nationwide firm. You may know the firm by its previous name, Burns & Porter. They're a long-term CAMPS member, and they joined forces with CBIZ in May of 2021. With over 20 years of experience in the industry, Nikki is a member of the Assurance Services Department and is the leader of the office's Distribution and Manufacturing Services Practice Group. She specializes in audits and reviews of manufacturing and wholesale distribution companies. Most recently, she's focused her efforts on assisting clients through the COVID-19 pandemic, providing valuable consulting services on the PPP, otherwise known as the Paycheck Protection Program, and the PPP loan forgiveness, as well as the Employee Retention Tax Credit and the optimization of the two programs. Just talking about those is a mouthful. So with that, I'd like to say welcome, Nikki. We're happy to have you here.
Perfect. Thank you, Debbie, and thanks for that fantastic introduction. I appreciate it. And I also appreciate you saying that this information is not boring to you, because it's totally not boring to me at all. So I hope, the goal of this presentation is for it to be relevant and useful content to everyone on this call. Yes, there are, like, as Debbie said, starting off on this, it is a mouthful of words. There are a lot of acronyms, especially with the COVID programs, PPP and ERC. And so, today I'm going to go over a gap update. That's kind of where I focus, as well as PPP and ERC. So a lot of acronyms, a lot of content. I'm going to share my screen in just a minute so that you guys can see my slides. And I am happy to share my slide deck at the end of this too, with the group. So however Stacy wants to facilitate that, that will work for me. So, okay, I'm going to start sharing. All right, I should be sharing my screen. Can I get like a thumbs up from any of the
Yes.
other people?
You got
Okay,
it.
perfect.
It looks great.
Thank you. Thank you so much for that information. Okay, so this is the tax and regulatory update for camps. You know, as Debbie said, starting off on this, there are 3 different speakers in this, and we've definitely split up the content in a useful and relevant way to everyone on here. We're definitely not going each other's content. We'll have our own areas of expertise. So that's what we'll be talking about today. And as Debbie had noted coming into this, you know, I was with Burnson Porter, a longtime member of camps. In May of 2021, we joined forces with CBIZ. So that's why you see CBIZ on here. And then MHM, which is the independent accounting firm that's associated with CBIZ. So when you see CBIZ, MHM, they're kind of one and the same, a little bit different kind of behind the scenes, but for the most part, we all integrate together, and that's how you can know us now. Okay, so this is me. This is my contact information. Hopefully I look the same here, kind of as in that picture. That's a pre-COVID picture. But what I'm going to be talking about today, and I have about 20 to 25 minutes. That's what all of the speakers have. So the way that I'm going to try and break this down is GAAP update. There's kind of a potpourri of items that I want people to know about from a GAAP update perspective. That is the world that I live in, but I also recognize that that's probably the least exciting for people to hear about. So I am going to spend probably about 5 minutes on that to try and go through the updates that business owners need to know. I think that people are more interested probably in hearing about PPP, so Paycheck Protection Program, as well as the employee retention tax credit. So on each of those 2 items, I intend to spend about 8 to 10 minutes talking about those on each of those programs. So that's kind of the way I'm going to frame this discussion. And then of course there can be questions afterwards too. And I did just want to spend a minute talking about CBIZ a little bit because we are, you know, new to this market, right? It's the same Burnson Porter firm that you guys have known and loved for many years. We just have a new name now. We have a ton more services that we can provide as well. So accounting and tax is definitely what you know, but we definitely have a benefit and insurance side of things that we can help out with. So it's just a little overview on that. CBIZ, one of the great things about us joining, we have 120 people in the Bellevue office. That's the same number of people that we had with Burnson Porter. But in joining forces, we're now part of the top 10 largest accounting firms nationally. So this just kind of shows our reach throughout the United States, the major markets that we're in. Just added a huge new office in New York. So if you have a question, you know, if you if as a business you are looking at opening up a location in, you know, a warehouse in Denver, for example, right? I have people on the ground that I can call there and help you out with that, for example. Last little thing about CBIZ, you know, just the reason that this acquisition worked for Burnson Porter is because our mission and values aligned very closely with CBIZ. The top 2 core values on the left side, we do the right thing and our people matter. That's always been top for Burnson Porter. So that's why this made sense for us to join forces with CBIZ. Okay, now that I'm done with all of that, I'll get into the details a little bit. And like I said, I'm going to start with the GAAP update here. And this is definitely not all of the GAAP updates that are relevant for this year. I kind of picked and I did a pick and choose on what I thought was going to be most important. And even on these items here, not all of these will apply to all companies too. So the one that I'm going to talk about in depth the most is the ASC 842, which is lease accounting. And I have a couple of slides coming up on that, so I'm going to discuss that next. A couple of other things that I think might be most relevant to people on this call that are effective for this year is the accounting for government grants. And this kind of feeds into what I'm going to be talking about later on too, with the PPP loans and the employee retention tax credit, as well as FFCRA credits. That is some of the potential tax credits that are available for COVID sick pay for employees. But on these government grants, especially, and I would say the biggest one here is the PPP loan, is if your company did receive a PPP loan and you have not yet received full forgiveness from the SBA on that, right? Because there's a process on these loans. They need to go through the borrower, the company needs to apply for forgiveness to the bank, and then the bank needs to pass it along to the SBA, and then the SBA needs to grant full forgiveness, right? And so we know that this takes quite a long period of time, or it can take quite a long period of time. And so there's definitely some gap as to how you can account for that, whether you account for it as debt, as a liability, or if you choose to record income in the current period related to that. So there's definitely some rules there that I can speak to further on a particular situation, or you can talk to your accountant on that too. As far as improvements to related party guidance for VIEs, so VIE is variable interest entity. And so the way that we see this in common practice is if there's an operating company and that operating company then leases building or office or warehouse space from a related LLC. There's definitely, there's a little bit of updated guidance into how we perform our analysis on that. And I would say that's a fairly common situation with my client base. And then the last one that I wanted to touch on that I thought might apply to people, to companies on this call would be is if you have goodwill on your balance sheet. There's some new guidance on there about how you can measure for a triggering event. So unfortunately with COVID, we've definitely seen, some businesses are doing fantastic. They have a product or a service that people really need right now, or they've been able to pivot in such a way to really kind of launch their business. Other businesses are not doing as great. So there could be a potential evaluation for goodwill impairment in those cases. Okay, so I'll go to the next slide, talk about leases, because like I said, this is the one that is basically going to apply to all companies or the majority of companies. The leases has been kind of hanging around for a little while. I think it was back in 2016 that this was introduced. And so a lot of companies have leases, right? So companies have various contracts, right? And this is kind of this slide is kind of a pictorial, it's a circular process on evaluating the lease and figuring out what are the components of the contract, how do we classify it, what's the accounting treatment, and this is something that a business will need to do for every lease that they have, whether it's a building lease, office, warehouse, a yard lease, maybe an equipment lease, or some sort of vehicle lease. There's a lot of things that fall into the scope of this. So really what this does is you'll need to get out your lease, and your accountant should be asking you to do this, and do an analysis on it, right? And pick it apart and figure out what are the components of it. Are there variable payments in there? Are there payments that are, based on hitting certain revenue levels, right? That's a clause that we sometimes see. Are there potential extensions that in the lease that need to be kind of accounted for within the analysis of it? The way that kind of the end goal of this, when we look at the accounting treatment, is we're going to put leases into kind of these three broad categories. If it's a short-term lease, so less than 12 months, you're generally going to treat it the way that we've currently been treating it, which is just expense it as you're incurring those costs. And this represents balance sheet, income statement, and cash flow is kind of the three layers there. If you do have what's going to be called a finance lease on this, which is probably going to be a long-term lease, think of a 5-year lease on your building space. What GAAP tells us we're going to have to do now, instead of just disclosing that amount of the future minimum lease payments in the footnotes is there's this new concept called a right of use asset and a lease liability. So that's where we're going to pull apart the terms of the lease. GAAP gives us some ways to calculate basically what the value is of that asset, that 5-year asset to lease the building, right? Because there is value there. And then we're going to book a corresponding liability that goes along with that. And then over that life, as we're ticking along on those 5 years, it's going to be recorded through the income statement. And that right of use asset and that liability is going to be amortized off over that 5 years. So it's definitely, it's going to be a big change, right? Because we're taking lease information from the income statement up to the balance sheet then. One of the biggest concerns that we've heard from clients on this, and I would say, banks are aware of this as well, and they've been working with their clients as well, is, we're potentially putting on a big asset and a big liability on the balance sheet. This could definitely impact bank covenants. So it's something, as we're going into year end right now, and companies are starting to work with their accountants on year end financial reporting, year end taxes, to just bring this up, say, hey, can we start doing a lease analysis? This is effective for this year, for the year ending 2022. So this is definitely a great time to start talking about it. If you think it's going to impact your covenants, definitely have your accountant get involved with talking to the bank as well on that. See if any sort of renegotiation or anything needs to happen on that. And then, so in addition to putting the leases on the balance sheet, within the footnotes, there's going to be quite a few expanded disclosures on the leases as well. Basically just giving the user of the financial statement, right? User of the financial statement is generally going to be either the bank or, excuse me, company management, potentially some other investors, but basically giving more information about the leases, more qualitative and quantitative information out there. And then last thing on the GAAP side that I wanted people to know about that I thought was important is that this year there's going to be a new auditor report. I would say the content of it is different in such that now we're moving the opinion up to the top of the report. So it's very easy for the user of the financial statement, again, whether that's company management, whether that's an investor, whether it's the bank, basically we're moving our opinion up to the top. So it's the first thing that people read, and then really talks about the basis of the opinion, and then some enhanced disclosures on responsibilities and potentially going concern and that type of thing. So that's going to look a little bit different on the financial statement report this year as well. Okay, I think that's my 5 minutes on GAAP. So now I'm going to jump to shift gears a little bit, and I'm going to jump to PPP and Paycheck Protection Program. I think that, I've talked to a lot of clients about this. I've talked to a lot of companies about this. I know that there's a lot of companies on this call that received a PPP loan. I would say the program is basically over as far as the funding of these, loans go. Right now, we're really into the forgiveness process. And so unfortunately, if your company didn't get a loan, like I said, the funding is gone. That's just kind of the way it is. The PPP was established in March 2020, right, as part of the CARES Act. April 2020 is when these first draw loans started going out. And it was definitely, it's been a journey for everybody involved with these. The rules were definitely changing fast and furious right at the get-go. COVID was really an unknown situation back in April 2020. And so as part of the CARES Act, right, we have these forgivable loans that were issued by banks, right? So a local bank would issue these loans, and then they're basically guaranteed by the SBA, right? And so these loans were really beneficial to companies because this gave them stability, right? They were able to keep their people employed, right? They were able to basically just have kind of a funding bridge to be able to not lay off people because we didn't know it was coming with COVID, right? And so this, basically the rules on this is if a company was able to use the loan proceeds for a qualifying expense, which is generally payroll, as well as some rent and utilities. And the definition kind of expanded over time a little bit, but I would say generally payroll was the big intent on this. The company was able to get a forgivable loan. But the hitch is, and I have seen a couple of companies kind of fall down over this or falter on this, is you actually need to then take some action after getting this loan and after your covered period is done. You actually need to apply for forgiveness. And so there's 3 forms that you can do that on. It's Form 3508, Form for the 3508 EZ, which is and that's generally for businesses that either just didn't cut employees or were greatly affected by COVID. And then for businesses that are smaller that had a loan of less than $150,000, there's a streamlined application form on that. So generally we kind of have the PPP 1.0 and then 2.0, which is first draw and second draw loans. Companies were potentially eligible for up to $10 million in that first round. And then in 2021, there was a second tranche of funding for companies. If they had a 25% revenue decrease, they were potentially able to get up to $2 million. So again, this is a huge program. We're in the process of the final accounting for this. So there's over 11 million loans that were issued, $791 trillion. Like, that is a lot of money. And right now, like I said, forgiveness is going on. Over 80% are either fully or partially forgiven by the SBA. So there's still 20% of that hanging out there. Like I said, a company does need to take action to on this forgiveness process. So kind of what I'm seeing right now as far as PPP goes, everyone's covered period, even a maximum of a 24-week covered period, should be over by now, right? So you should be getting in your forgiveness application. I have helped a lot of people with that. So definitely you can contact me if you need help with that. I'm happy to talk to you about that process. But kind of what I'm seeing a lot of right now is a lot of increased communication from the SBA, asking for additional documentation from borrowers. So on those forms, the very last page of the application had a section that was called documents that the borrower must maintain but is not required to submit. So it talked about maintaining all of your employee records and your FTE counts and all of these, all of like the proof that you didn't necessarily need to submit with the original application, but you needed to have on hand. I've seen more than a handful of cases now where the SBA has sent a letter and they're sending it through the lender. So they're sending it through your bank, and then the bank will come and talk to you to ask for additional information. I've seen letters from the SBA where they are asking for that the company could use Form 3508 easy. So, right, like I said, that's an easier form to use, but you're basically just checking a box to say, yes, we were affected by COVID, or yes, we didn't cut we didn't cut our hourly or salary wages or number of employees. And so the SBA will say, great, thanks for checking that box. Now please prove it to us. Another one that I've seen recently is basically just the eligibility to receive a loan. So like I said, in April 2020, I mean, money was going out fast and furious. Everyone was just trying to get in before the program funds ran out. I've seen a number of cases now where the SBA has come back, and I would say actually these next 2 bullet points go in tandem, where the SBA is now coming back and looking at the company's eligibility to receive a loan. Is the company, was it of a certain size where they were eligible to receive a loan, right? Because generally you needed to be less than 500 employees. There were some additional SBA size standards rules that came into play where a company could have more than 500 employees. And also, was it in an allowable industry? So there were a couple of carve outs in the industries. like private equity, for example, right? Like there's some rules around that on getting the SBA on the PPP loan. And then also just the recalculation of the original loan amount. I've seen a number of cases right now where the SBA has said, okay, we gave you a, $2 million loan. Prove to us now that you were eligible to get that $2 million loan. So basically a recalculation and an audit of the original loan amount. So so even if you're a business that has been fully forgiven all the way, made it all the way through the SBA, in the fine print on those applications, it does say keep all your documentation up to 6 years. So really just, I would advise anyone on this call just to go back through your file, make sure you've documented everything, make sure you've documented your need for the loan, why you needed to have it in the first place. Make sure you have all of your employee and FTE counts. And just kind of make sure all of your documentation has a bow on it and file it away, because someone could come looking for it up to 6 years. Unfortunately, I don't know what that potential is. It's probably going to be depending on how the political climate goes from here on out, as far as the level of emphasis that the SBA is going to have on some of these future. And then the last thing, which kind of segues into my last topic on this, is even if a company received a PPP loan and has had it fully forgiven, the last step that I want a company to do is to go through and evaluate if you're eligible for the employee retention credit. So the employee retention tax credit is a pretty valuable credit that's available for businesses. It did come about as part of the CARES Act in 2020. And as part of the CARES Act, there was the PPP and there was the ERC, and there were a number of other incentive programs, but really those are the two that we're talking about right now. And the original legislation was, excuse me, was drafted such that a company could either receive a PPP loan or employee retention credit. The PPP at that point in time was way more valuable to companies. So that's generally the route that most businesses took. The employee retention credit did not get really didn't get a lot of press and a lot of traction. Then we come along to the end of 2020, and we have the Consolidated Appropriations Act, which basically said, okay, if a company got a loan in 2020, a PPP loan in 2020, actually they can now be eligible for the employee retention credit. So it brought, a whole tranche of businesses which were, excuse me, not previously eligible are now eligible for employee retention credit in 2020. And then it got even better in that legislation where they said, okay, we're going to expand this employee retention credit for 2021 and make it easier for businesses to qualify as well. Okay, so there's two ways that you can qualify for this. And you can either have a significant decline in gross receipts, or you can be shut down due to a governmental order. So this gross receipts test is pretty significant for 2020. Excuse me. You need to have a 50% reduction in gross receipts over the same quarter in 2019, right? And we're looking back to 2019 because, excuse me, that was pre-COVID. 2021 is not as dramatic. You need to have a 20% decline in gross receipts on that same quarter in 2019. So definitely more generous. We also look at the number of full-time employees in 2019 as far as being able to qualify. So 100 and 500 are kind of the numbers. If you have more than 100 employees, you probably don't qualify for 2020 ERC. For 2021, that number is 500. And then we do need to look at any brother sister companies as well for aggregation rules. So this is a payroll tax credit. It is claimed on the 941. And right now it's going to be an amended 941. So it's the 941X. Okay, so if you determine that you're eligible for ERC, which is, excuse me, something that I can definitely help with, the one thing you need to do is you need to navigate around the payroll that's used for PPP as well. You can't double dip on those two payrolls. I'm sorry. You can't double dip on those two payrolls. So what you do need to do is you need to make sure that you have enough wages to maximize both of those. That's something that I've definitely helped out a lot of clients with. And demonstrating within the two calculations for PPP and ERC that you're not double dipping there. Let's see here, and I will say on this, any shareholder wages, anyone basically that's in the same family. So if you have kids working for you, you can't be eligible to get the on those employees as well. As far as dollars, these are pretty big dollars that we're talking about. So like I said, there's 2020 and then there's 2021. Okay. So for 2020, right, like I said, you want to have a 50% or more decline in your gross receipts. The way that the 2020 credit works is it's a maximum of 50% of qualifying wages. Basically, it works out to a maximum of $5,000 per employee for the year. 2021 definitely gets more generous. It works out to be a 70% credit on qualifying wages for the quarter. So potentially a maximum of $21,000 per employee for the year, or for for Q1, 2, and 3. There is no more ERC for Q4. Okay, so where to go from here? If, like I said, I've really worked with a lot of clients on optimizing both PPP and ERC. I would say any tax advisor or any CPA should be able, your CPA should be able to help you with that as well. First step is really just to determine if you had if you were either affected by the shutdown in 2020, or if you have a drop in gross receipts. From there, then you can dig into the wages paid to employees and figure out if the company is eligible, and then next steps on claiming that credit potentially on an amended 941. Okay, so I guess it's Q&A time, so I can take some questions from the chat, or if people want to think about it, or you can message me privately in the chat and I can respond. I think that's where we're at.
Thank you, Nikki. We appreciate your presentation. I hope you're okay. It's hard to give a presentation when you have a cough like that.
Yeah, I apologize. I am also in my own office and just, coughing to myself.
You gave a really detailed presentation, and there's a lot of information there. So what I'm going to do is I'm going to put your contact information right now for everyone in the chat. So if you're interested in connecting with Nikki, there's her information, as well as sounds like people really need to gather their documentation and get information together around the PPP loans if they've gotten one. I definitely am going to follow that process. I hadn't thought about that, and if they come back to me, I think it might be a little scattered. And you say that there's no way to get PPP loans now, is that right?
Yeah, unfortunately, I think the last of it was kind of May, in May of 2021. So by now, business should have run through their covered period, but there is still employee retention tax credit available that can be claimed on an amended 941 for up to 3 years. So okay, no rush on that, but definitely good to be asking about.
So if people want to look into pursuing that, they could contact you for some assistance with that. The other question I had is, if someone hasn't applied for forgiveness, is there an exact deadline? I know it was staged and people got their PPP loans at different times. So when is the cutoff for that?
It certainly is kind of a staged process. The technical answer is 10 months after the end of your 24-week covered period. So for the most part on that, we're seeing anyone who received a loan in 2020 probably should have applied for it for forgiveness by kind of August, September, October in 2021. Second draw loan, which would be if you got your money in 2021, I would say we're kind of in that process right now, getting to the end of that 10 months after the end of the 24-week covered period.
What if somebody?
In reality, I
Go
will
ahead.
say I was talking with a banker the other day, and there are at this particular lender, there are a handful of borrowers who have taken no action on this. Like I said, they didn't realize they needed to submit a forgiveness application for whatever reason. So we are starting with the bank and starting the collections process. So you don't want to be in that process. You don't want to have the SBA act on the guarantee, right? Because then you're getting into potential problems with defaulting on a federally guaranteed loan. So if you are like, oh my gosh, I got this loan, I totally forgot about it for whatever reason, I would say just work with your lender, get your application in.
Okay, I was going to ask you, that was my next question. If somebody had not met the deadline for forgiveness, they can still work with the SBA or their lender to. For
sure, yeah, work with your lender on this. They're the intermediary between the SBA and the borrower.
Great, thank you very much. That was really informative.
Thank you so much.
And I did put Nikki's contact information in the chat, and I'll put it again in the end. What I'd like to do now is introduce our next panelist. Her name is Dora Leung. Dora is a shareholder in Clark at Clark Nuber Tax Services Group, and she leads the firm's manufacturing and consumer products practice. She focuses much of her time working with a variety of privately held manufacturing and consumer product companies, including retail, durable goods, equipment, electronics, building materials, seafood, food processing, wholesale, and distribution companies. She's got a big portfolio. She works with her clients to implement tax efficient operating structures in order to provide best tax solutions to both business and the owners. And she also specializes in helping companies on international expansion by working hand in hand with the local and international team and advising on tax issues on global operations. So welcome, Dora. We're excited to hear from you today.
Thank you, Debbie. I'm going to share my screen. So I'm going to give a update on kind of the tax regulations and well, actually what's in the horizon. The Build Back Better plan actually did not get passed in 2020. At the end of 2021, everybody kind of expected, something will happen before the end of the year, and of course it didn't happen. So now we are kind of like in the, in the tax world, we were kind of wondering what's going to happen, when it's going to be passed. So what I'm going to do is I'm going to divide my presentation in 3 different sections. Actually, I think I need to put this up. Into 3 different sections. One will be what is the significant tax proposals that might impact business. And then the second one will be what would be the tax planning ideas for manufacturers. Kind of like in the meanwhile, we don't know what will be the new tax law, what will be the impact, but these are the things that you can still do in the next, in the next few months until, we are clear about what will happen with the proposal. And then last things I'm going to cover, as Debbie mentioned, I do help manufacturers or my clients to expand globally. So I'm going to touch on some of the international tax incentives as well. So I'm going to start with significant tax proposal under Build Back Better Act. The first one I want to touch on is R&D expenses. which is different than R&D credits. And I'll touch on R&D credit when we talked about tax planning. So R&D expenses, it's expenses that company incurred to work on our research and development process. So for example, some company will have software development, or they would have costs that they incurred for quality assurance or testing. In the past, before 12/31/2021, the tax law will allow you to deduct R&D cost immediately during the year of when you incur the expenses. That law has expired. So if the Build Back Better Act does not extend the expensing through 2025, you will be required to capitalize all these research and development costs, and you will have to depreciate it over either 5 years or 3 years. There's specific rules inside. It depends on whether you've completed the project or when do you place the project in service. So this is one of the things that is important for a lot of the clients that have significant R&D costs incurred during the year. Let aside, even if they don't take the benefit of an R&D credit, this could potentially requiring company to capitalize the cost as an asset and then depreciate it over the life of the project. Second one, pass-through business taxes. That is related to net investment income tax. There's a 3.8% net investment income tax that has been enacted for a few years now. However, under the current act, it is going to extend all the way to not just passive income. In the past, if you are an S corporation owner, for example, and you pretty much actively participate in the business, the income will not be subject to this 3.8 add back. It's what we normally refer that to. The current act proposal has called for the tax to be applied to even active business income. And it will only apply if your income is what they consider to be your high taxpayer, meaning if you earned $400,000 as a single taxpayer or $500,000 as a married filing jointly taxpayer. So this is no doubt one of the item that is calling a lot of controversial discussion. As the idea was trying to make sure that if you're actively business, and some companies were doing some active planning to convert to an S corp to avoid this particular tax. And however, IRS, their point of view is business owner, especially S corp owner, they always try to modify their wages to make sure that they are not paying a lot of payroll tax and having all of their income as flow-through income to escape this particular add back of Medicare tax, etc. So that is one of the reasons why it is being it's currently under the act proposal. Excess business income losses limitation. This is not new. When the TCJA was enacted, there was this particular kind of restriction in there that disallowed business owners to take any a business loss in excess of $500,000 in any given tax year. So the business owner can use this excess business loss to offset their other ordinary income. So this Build Back Better Act is right now it's saying that they're going to make this loss limitation permanent. And instead of in the past, when you have excess business loss in year one, then if you have excess business loss that you couldn't deduct in the current year, then it will carry forward in future year as a net operating loss. So, not the end of the world because, you could still utilize it, even though it's subject to a limitation, you can still utilize your excess business loss in the future. The new proposal, call for creating a completely separate tracking of this carry forward for unused excess business loss rather than, having you carrying it over as a as a net operating loss. So for that reason, it's actually gonna be subject to further limitation if let's say in the next couple of years you still don't have business income to offset that. You probably couldn't use this to offset your wages or other ordinary income. So that's another proposal, kind of like tax unfavorable, I think, tax proposal that is in the current act. Something nice, not everything is bad. So state and local tax deductions. I think a lot of probably the participants here also realize that for state and local tax deduction has been limited to $10,000 at individual level and living in the Pacific Northwest, or how expensive is your property tax. So it doesn't really leave a lot of the room for people to deduct if they have passed through state income tax from their business. So the current proposal asks for raising the cap from $10,000 to $80,000 for individual for tax year 2021 through 2031. This is beneficial because right now a lot of people are capped out on their itemized deduction, and they can't even take itemized deduction because they just don't have a lot of taxes, or when you add up your mortgage interest expense, probably you might be better off by just taking the standard deduction. So raising this cap, it's beneficial for business owners to continue to get the benefit for the state income taxes that they are paying to various states that they operate in. I do wanted to bring up another thing. It's a lot of the states have also come up with their own way to try to alleviate the issue for business owners not being able to deduct their state income tax expenses. And one of the solution would be allowing the business to deduct the state income tax expenses at the business level instead of passing it through to the individuals. It varies state from state. Some states are a lot more advanced on that, and some states are still working through their development on it. So definitely when you are thinking in terms, planning in terms of what you wanted to do for state income tax purposes, make sure that you've gone through the analysis to see what it could be. And obviously this hasn't passed for 2021. The Build Back Better Plan Act has not been enacted. So for 2021 purposes, you probably could look into the state solutions if there is one. For example, California has one, and Maryland has one. So definitely look into that and see if shifting the state income tax expenses to the company might actually make more tax sense for you. The next item is qualified small business stock, what we refer to Section 1202 stock. IRS has allowed in the past, if you hold C corporation stock, and if you hold it, if the stock is being issued after a certain date, and if you hold the stock for an extended period of time, you could potentially get a zero tax rate, exclude 100% or on the gain when you sell the stock. The current act, it's eliminating the 75% and 100% rate, and keeping only the 50% exclusion rate, and also restoring a 7% add back on your AMT tax. So what it does is effectively changing your effective tax rate of 0% if you own qualified small business stock to up to a 15.9% income tax rate if this law passed. So, some companies have converted to us, that they have recreated a C Corp, to take a benefit of this. So, definitely we'll need to revisit, especially if, it's still a benefit, a capital gain rate is 20%. So, qualified small business stock will still give you a benefit. But that probably if you hold any of these small business stock, you will want to watch out to the development of this particular proposal items. So other tax incentives and modifications that I'm not gonna spend a lot of time to go over those. There is, green energy credit. That's, one of the huge, focus on the plan. And also there's incentives for, infrastructure and supply chain. That is, I mean, we've probably all experienced, issues with supply chain and, kind of like, with the infrastructure. So that's, one thing that is, there's a lot of, incentives and credits that's applicable for, these type of transaction. And then another one, it will only apply to, if you operate internationally, is there's new limits on, how you utilize your foreign tax credit, foreign derived incentive, intangibles income deduction as well, which I will cover part of that when we talk about the international tax area. So I'm going to shift to the next topic, which is, what you can do now still, even though, the plan has not been passed. And here's, some of the things that you will want to pay attention. So depreciation expensing under Section 179 and bonus depreciation. Section 179 limitation, currently it's about $1,080,000, which allow business owners to write off, any CapEx that they place into service in the current year, immediate write-off, to, kind of allow you to preserve your cash flow for, not paying taxes. Section 179, it's, have income limitation. So you can only take Section 179 if you have, that amount of income before you can start taking Section 179. A lot of the company do take, instead take 100% bonus depreciation. This particular depreciation benefit is set to expire as of 12/31/2022, and it will start to phase out. I've listed, when they will be completely phased out in, after 2026. So that, there should be some planning, if you have, something that you were thinking about placing in service, your CapEx expenditure, whether you're going to put it in 2022 or 2023, that could make a difference of, what you wanted to do. Benefit for, bonus depreciation. Also, there's no income limitation. So bonus depreciation hypothetically can make a business create a tax loss, which, we've talked about, even though it's subject to excess business income loss, it could still potentially offset some of your other ordinary income. So this is, very powerful, if you have, plan to place into service, any fixed asset. We don't know if, there will be any modification, because, bonus depreciation, if government is encouraging, business to, continue to invest, this could potentially have some modification in the near future. But as of right now, if nothing gets done, then it will start phasing off in year 2023. Research and development credit. So this is a tax credit for development or improvement of new or existing products or processes. I think a lot of manufacturers didn't realize that they would also qualify for R&D credits. A lot of the time, I think the myth is, only high-tech industries or, a company that, spend a lot of time on software development would qualify for R&D credit. That's actually not the case. Any money that you spend, related to development or of new or improved, products or actually processes. So manufacturers do, involve in a lot of processes, such as, they probably would have to determine like tooling requirements, or, they will always, look at how to, improve their quality assurance process. Maybe you're developing robotics or automated technology. Any of these, will qualify potentially for R&D credits. With that, R&D credits, if you have employees that have the title of like engineers, quality assurance tester, or like designer, those will be kind of the buzzwords when you, think in terms of, do I have any expense that I might qualify for R&D credit? If you have those, definitely, explore, talk with your tax advisor about that, because they could be, they are dollar for dollar credits. So that's, really great. If you're at a 37% tax rate, that means, you'll save 37 cents on a dollar for anything that you spent on, research and development credit. Startup companies, there is a special incentives if they don't pay any tax. Let's say they are not, taxable. They do allow startup companies. There's different regulations that define what is a startup company. You can use your R&D credit against your payroll tax. So even if you don't have income tax, you could still benefit from taking a research and development credit. Cash versus accrual method of accounting. Any manufacturers with 26 million or less gross receipts could elect to use cash method of accounting if they choose to. I'm going to talk about why cash method of accounting could be beneficial. I mean, it's not for everyone, but it could be beneficial. For example, if you're a cash basis, taxpayer, you wouldn't have to capitalize any labor or overhead into your inventory. You only need to capitalize the actual cost of your inventory, which alleviate a lot of the extra tracking, what we refer to Section 263A capitalization. This particular exception, it's very beneficial for smaller or mid-sized manufacturers, so that they don't have to spend a lot of energy tracking how much labor or how much overheads that I need to capitalize back into the inventory and calculate, and maintaining two different value of inventory, one for tax and one for their book purposes. So that's beneficial. Also, cash accounting will allow you to pretty much see your you only get taxed on what you received. So your accounts receivable, you wouldn't have to pay tax on your any advance payment that you've received, or any sales that you haven't completed. So that's why it's also beneficial for that.
Dora,
Yes.
could you scroll up? A couple of people in the audience, they're having a hard time seeing your full slides.
Okay, sure.
Thank you. Sorry to interrupt.
Yes. Oops. Okay, I'm probably gonna do this.
That looks good.
Yeah, okay. So, okay, so the next one is qualified business income deduction. I'm sure a lot of the taxpayer have already taken the benefit of this. This essentially, it's a 20% deduction. It's only through 2025 of the company taxable operating income. They're subject to limitation. You have to be either the limitation will be up to 50% of wages, or 25% of wages and 2.5% of qualified property. The reason why it's subject to wages limitation is they wanted to discourage company to not utilizing employees and do a lot of contract and pay their employee as a contractor. So definitely this is a powerful deduction. It will drop your effective tax rate 20% below the tax rate. For example, if you are a top tax bracket, any of the qualified business income will only have a tax rate of 29.6%. So that's powerful, and making sure that you are taking the deduction. I would say all of the manufacturing companies should qualify, and any of the consumer product companies should qualify. They shouldn't be considered to be one of those special business that is subject to further limitation. If you are one of those special businesses, then you will have to look at your income level, and it could be subject to further limitation, and it will reduce the amount of your qualified business income deduction. But if you are not a specialized service, which like I said, most of the manufacturing company should not be, this business income tax deduction could be a very big deduction and there is no limit on it. We'll also want to bring in a attention about interest expense limitations. In the prior years, interest expense limitation would allow a company to calculate their interest expense deductibility using their taxable income, their 30% of their taxable income, but you will be allowed to add back the interest expense. You'll be able to allow the depreciation and amortization. So more of a looking at what is truly your cash flow position. However, starting in 2022, interest limitation and again, interest limitation, it's only going to apply if you have gross receipts of over $26 million. So if you don't, you should not be subject to this interest expense limitation. But starting in 2022, they're going to take away the depreciation amortization add back. So you have to pay attention, look at your, maybe your projected income statement. So you wanted to not be surprised, at the end of the year that, part of your interest expense might not be deductible and, causing, your cash flow surprise, for, maybe you'll have an increased tax liability because, you can't deduct 100% of the interest expense that, you've incurred during the year. So that is something that is already happening, I think, in 2022. So, if you have not looked at, your current, maybe cash flow analysis or, your projected income, this will be the one thing that will definitely encourage you to take a look, soon. One other item that I didn't put it in here, that is for the benefit of, because of the COVID relief, companies, if you spend any money, this only for 2021 and 2022, in the past, when you spend any money on meals and entertainment, you'll be subject to either a 50% or 100% limitation. For 2021 and 2022, if any business spend any money from restaurants food, so this is a particular, I think, relief for, encouraging business to, help out, local restaurants and kind of helping the, the food industry, is you'll be allowed 100% deduction on any expense you spend on restaurant food. So that doesn't mean you have to eat at the restaurant. So if you bring, let's say food back into the office and, to feed your staff and, feed your crew, those will not be subject to any 50% or 100% limitation for only 2021 and 2022. So that's, one benefit that, if you are not aware of, probably let your your accountants know to make sure that they can flag it, differently, so that, at the end of the year, when you prepare your tax return, you wouldn't have to go back and look at each transaction and, flag out, what is, really we spend it from, restaurants, or, we, order it, from, different types of, kind of meals and entertainment expense. Finally, I'm going to touch on some of the international tax incentives. This is more about, there's two, pretty much if you export to a, foreign jurisdiction, there's, usually two, kind of methodology that you can use. One is being a foreign derived intangible income deduction that you can go through. It's what we refer to an interest charge. This which is a organization that you will have to set up a separate corporation to act as your export sales agent. With that, you can pay the export sales agent a commission, and the this sales organization is a tax exempt organization. So the IC this company does not pay any tax itself. What it does, it will pay dividend back to the owner of the IC-DIS corporation. So what it does is pretty much, converting your ordinary income to a dividend income. So with dividend income, still have a preferential tax rate. This is also beneficial because, if your tax rate is 37%, for example, assuming that you qualify for the QBI deduction, which will drop you to 29.6%, but dividend income, it's at a 20% plus potentially a 3.8%. So you still gain the delta of the rate differential, which is a permanent tax savings. The only difference between the NYSE and the foreign derived intangible income deduction is foreign derived intangible income deduction does not require setting up a separate company. The IC does require setting up a separate company. And with that, you also will need to file a income tax return. So you have to look at, what is the magnitude of your, for your export sales and see whether this makes sense, because it does come with some extra cost for maintaining the corporation and also, filing a tax return. So those are the two. There's a lot of international tax provision in the Build Back Better plan, but I'm not going to go through a lot of those. A lot of them are more geared towards, company with, kind of like a big, C corporation that has, a lot of like, book income, and they, probably have a ton of, subsidiaries that they will generate foreign income tax credit. And a lot of the calculation will be go through country by country. So that is a pretty big change for international, kind of global organization. So I'm not going to bore all of you with that information. That probably can take another whole section to discuss. With that, I think I'm through with and here's my contact information. I'll be happy to answer any question at this point, and I will send the PowerPoint to Stacy so that she can share with the participants as well.
Thank you so much, Dora. What came up for me is there's so much new tax legislation, some of it active or some of it potential. If I came to you, what are some key dates and potential timelines that I should keep an eye out for?
Yeah, so I think right now it's not really moving. It's moving very slowly. But one of the key dates I would think February 18th would be one of the key dates that I will pay attention to, because that will be when the government funding will stop. So definitely they will have to come up with something before that date. So I would say sometimes in the next couple of weeks there will be probably more movements of, whether, they will have to propose, more streamlined, proposal, or, what are they going to do, or, will they take out some of the provision? That will be the key date that I will pay attention. And a lot of these proposals, they are not all effective 2021 or 2022. Some of them has an effective tax date of after 12/31/2022. So that could be something that they would still have a lot of time to kind of get over all those movements, or fine tune, or whatever you call that.
Okay, so realistically, it would apply to 2022 or later then?
Yes.
Probably. Yeah. Okay. And then, you talked about cash versus accrual tax reporting. What are the pros and cons of that?
Sure. So I think for, like I think previously mentioned, cash and accrual tax accounting, it's probably not for everyone. For cash accounting, it's simple. It allow you to not having to track, certain items, with two different, you don't have to, worried about, accruing a lot of items, or, making sure that you have to make sure all the, invoices are, entered. However, depending on whether you also have a financial statement reporting requirement, if you have a loan, a lot of the time, I think GAAP accounting, require accrual accounting. So, if you, will be on accrual accounting for financial statement reporting purposes, if you do tax accounting for tax, it's an extra work, but, sometimes you need to look at the pros and, the benefit that you will get for tax purposes. You might still want to consider to be cash basis for tax, for tax purposes. It's simple. It will tell you exactly, how much cash that you have on hand and how much, income will tie into how much cash that you have received. So for ease, ease of managing purposes, it's easy. It helps with your year-end tax planning. You know exactly you pay that much more bills. Your income will be reduced by that much more. So that's easy. I would say the cons will be, let's say, you look at your income statement at the end of the year, you might not have, realize that you just have some bills that you haven't paid. So, technically, whatever is sitting, in your cash account might not be, what the realistic full pictures for you. Also, there's limitation. I've mentioned, if you're 26 million, gross receipts, below, you can choose between cash and accrual accounting. But if you're over 26 million and if you have inventory, IRS does not allow you to be on a cash method of accounting. So there's different ideas or requirements. Definitely will decide whether you should be cash or accrual. I have one recent example was a client was being acquired and they were in cash method of accounting. They were required to change to accrual because their buyer is an accrual taxpayer. So there's also unforeseen circumstances that will disallow you to be kept on the same method of accounting, for example. So it's hard to say. Definitely, if you think you qualify for cash accounting method and if you wanted to explore that, talk to your tax advisor again, to make sure that they do an analysis for you to see whether it's truly beneficial for you.
Okay, thank you. It sounds like there's so much going on in this tax arena and that you've got your finger on the pulse of it. So thank you very much for sharing that with us. And I've put your contact information in here for people who maybe haven't been talking to their tax advisor about some of these things. I think the Build Back Better has created a lot of confusion about what is and isn't taxable, especially for 2021.
Yes, exactly. Yes.
Thank you very much for your presentation today.
Thank you.
So next, I'd like to introduce M. John Way of Schwabe, Williamson, and Wyatt. John guides clients through the labyrinth of federal and state tax regulations, business, estate, and succession planning, and business transitions. He advises private business owners throughout the entire business life cycle from formation, operation, and growth, and through transition out of the business. So from cradle to grave, as they say in the software business, whether I just screwed myself up there, but tackling all phases of wealth preservation and estate planning, he creates customized strategies for the most complex situations. He also represents clients in their dealings with IRS and the state and local taxing authorities, including Washington State Department of Revenue. John has an LLM in taxation from the University of Washington School of Law, where he also was an adjunct professor in their tax program, and he received his law degree from Tulane University. So we're excited to hear what you have to say about state and local taxes. Thank you.
Well, thanks, Debbie. Let's see here. I will share my screen here. Should come up. In theory. Do you see that now?
Yes.
All right. You never know. So one thing, I'm not quite sure, what time are we ending? I don't want to keep people past.
We're ending at noon, and I think I've timed it so that you have plenty of time. You were planning on a half an hour?
Yeah, okay.
Yeah.
So again, yes, I'm a tax attorney with the firm of Schwabe, Williamson, Wyatt. Our firm's a little bit different than most law firms. We have a a strong industry focus in just a few industries. A lot of firms say they do this, and they, you know, it's kind of a marketing thing. But for us, we really do have an approach that where we as the attorneys try to really get into the industries and become very familiar with what your needs are and what and sort of things that you need to know about, your concerns, things like that. And one of our focus areas is manufacturing, distribution, and retail. So with that, I want to get going on our presentation here. So, you know, about a year ago, I did a lot of presentations along these lines, and when talking about the, you know, our state taxes, we were talking about, oh my goodness, we've got 2 brand new taxes that are going to be hitting people, and that's, you know, it's going to be very different and crazy. Well, as I think most of us know, it's not quite clear what's going to happen with these now. You know, a year later, we have this capital gains tax that I'm going to talk about in a second that is, you know, in effect right now, but a little bit in limbo. And then we have the new long-term care insurance tax that is in a very weird situation, also in limbo, but that at least will probably, we'll at least get some guidance and direction with that probably in the next few days. So let's start off with the capital gains tax. You know, as employers, you know, it's important to know about the capital gains tax. It's, you know, not only would, you know, if you have a sale of the business, would the capital gains tax potentially affect the owners when selling the business, but also sales of assets held by the business may also end up being subject to the capital gains tax, because if the business is what's called a pass-through entity, like a partnership, generally an LLC, an S corporation, those gains flow through to the owners, and again, they'll be subject to this tax. Here are some of the basics. You know, it is a 7% tax. The actual tax will not be due currently until 2023. So while the tax is effective for this year, it's effective on, you know, the gains that somebody might have during 2022 to be taxed in 2023. Similar to when you file your federal income tax returns. There are significant exemptions to the capital gains tax. Some of the bigger ones are the sale of real estate. Real estate sales are not subject to the capital gains tax, but remember, of course, they are subject to our real estate excise tax. Depreciable assets are also not generally subject to the capital gains tax. And we're talking about the gain on the sale of those depreciable assets. Also, there is a deduction for long-term capital gain on an individual's sale of their interest in a qualified family-owned small business. And this does affect a number of my clients and possibly a number of the people here in the audience. What we're talking about here is a qualified small family-owned small business. There's a number of requirements here that you need to have owned it for about 5 years or more. You or your family has to have materially participated in the business for 5 of the last 10 years, and you can't have too much revenue. So in the 10 year or in the year prior to the sale, the revenues can't exceed $10 million. And there are, again, some other ownership requirements. The families need to own a certain percentage of the actual business. But a number of people who were initially concerned, or that I'm hearing from regarding the capital gains tax, will be exempt or potentially exempt because of this particular deduction. So what are we talking about? How's this going to work? Well, remember that Washington has never had a capital gains tax and does not have currently an income tax. So the Department of Revenue is from whole cloth having to create all of the various things that it needs to administer this tax. So as we'll see, that none of those really have existed before now. Let's see here. The way it should work is when you owe you will make a determination that you're going to owe capital gains tax to the state of Washington. You will have to file a return to the state of Washington. We don't have that return yet. It hasn't been created. It is not going to be the same as the excise tax returns that we currently use. When you file the return, you will also have to include a copy of your federal income tax return. And this is a theme that we'll get back to here a few times because almost all of the terms of this capital gains tax rely on the terms of the federal income tax on how to determine this capital gains amount and things like that. So the return, your capital gains return, will be due at the same time that your federal income tax return is due. So generally that would be April 15th of the following year. If you file an extension for your federal income tax return, you can also file an extension for the capital gains tax return. It's not really clear how that's going to work. Again, the Department of Revenue is figuring these things out. The tax, it will, however, be due on April 15th, even if the return is extended. That's similar sometimes to income tax, but again, not clear how that's going to actually work. There are many things to be seen about this. And as I think most of the audience knows, right now, the reason this is potentially up in the air is because there are two significant court challenges to this. Both were filed in Douglas County. And the first, basically, the basis of the challenge is that the capital gains tax is unconstitutional because it taxes, it's Washington taxing assets that are actually outside of the state of Washington. And that would be unconstitutional under the federal Constitution, as well as the Washington Constitution. The second challenge is the one that I think most people have kind of heard the basis for a number of different challenges and a number of different attempts at creating an income tax or tax like an income tax in Washington, and that is that the tax is unconstitutional because it's a graduated tax on income, which is not allowed under our Washington Constitution. The two cases were consolidated. They were filed at different times. They were consolidated, and the state, of course, tried to get them dismissed. That hasn't happened, and now they're on briefing schedule. And I believe in the second week of February there will be a hearing on the merits of these taxes. So one thing I want to, people regularly, because I speak about this, ask me about, okay, well, what does this really mean? What are we talking about? Why, do you think it's going to be upheld? the first thing I want to point out is that while there is definitely an argument about it not being an income tax, or I should say an income tax not being constitutional, that is because all of the income taxes that generally the Democratic Party has pushed through the legislature or through Seattle's city council, things like that, have been graduated because they want a progressive tax. They don't want to tax people in the lower income areas, but they want to tax people with higher incomes. Well, that's what's not allowed. If under Washington case law back from the 30s, when an income tax was first attempted in Washington, Washington treats income as property, and property under the Washington Constitution must be taxed uniformly. So if you're just taxing property, it's got to be uniform. So under current law, you could have an income tax in Washington as long as everybody paid the income tax at the same rate. So we could pass a 2% income tax for Washington, where whether you made 10 grand or 10 million, you had to pay 2%. But that's not, of course, what this tax is, and it's not what a number of these sorts of taxes have been. So here we're talking about, again, the possibility of an income tax and it being a graduated income tax not being constitutional. To get around that, first of all, the state has couched this in the terms of that this is an excise tax, for the obvious reason that they do not want, they want to pass muster. They want it to be upheld because arguably if it's not an excise tax and it's an income tax, then it's arguably a graduated tax. Why? Because people who earn less than or have less than $250,000 of capital gains don't pay the tax, while people who have more than $250,000 of capital gains do pay the tax. So there's two different levels. Generally, excise tax, just to explain the difference, generally an excise tax is imposed on the sale of a good or service. While property tax, income tax is on the fact that you have that item. So we're going to tax it, the value of that item as you hold it. A good example of this for people to think of is how we treat real estate in Washington, right? So if you sell real estate, you're subject to the real estate excise tax. And the real estate excise tax is a tax on the selling cost of the real estate, and it's graduated. If your real estate is more than a certain amount of money, the rate goes up, and there's a couple of different graduated levels, and that's okay. It's an excise tax. But if you're not selling your property, right, and you're just holding it, every year you got to pay property tax, and that property tax is based on the value of the property as you hold it, and it is the same rate that all the other people are paying. Okay, now the value might go up and down, but the rate is the same. So that's kind of the difference. And here, in this case, the big argument and the big issue is that while the state is trying to say that really what they're taxing is the sale of those assets that create the capital gains, really, the problem is the way you determine how much those capital gains are is really an income tax concept. And if you look at the act that put the capital gains tax in place, all of the definitions of how much is the capital gain, what is it, how is it determined, all of these things all refer to federal income tax legislation. And as stated on here, you have to provide your federal income tax return. You have to, all of the things are based on your federal income tax return. And frankly, all capital gains taxes that have been enacted in the United States, both at the federal level and various state levels and everything, they are all considered income taxes. This is the first attempt to try to call it an excise tax. And it really, while there can be an argument made, it's really hard to say that it's an excise tax when you're really not taxing the actual amount of the sale of the assets, these capital assets. You're actually trying to tax an amount that you're determining based on, the gain, which is again an income tax concept. So, what does that mean? We don't know. The fact of the matter is, we are in limbo on the capital gains tax, and we're going to be in limbo for quite some time. There's going to be this hearing in February. The Superior Court will issue a ruling. There is no doubt that whoever loses is going to appeal this ruling. Generally, those appeals would go to the appellate court here in Washington. There is a chance that the Washington Supreme Court will simply, take the matter and hear it. Maybe not. One of the big concerns, though, is what happens at the end of the year, because right now, while the law is on the books, it doesn't actually affect anyone other than the fact that you should be, of course, tracking your capital gains as you would for federal income tax purposes. But on January, starting in January 1 in 2023, suddenly you owe this tax amount. So I would look for, at some point towards the end of this year, the plaintiffs in this case petitioning the court, whether it's going to be still the Douglas County Superior Court or more likely the Court of Appeals, asking for there to be an injunction against the state to stop the requirement of collecting this tax because the matter is still up in the air. Otherwise, of course, there could be a situation where the state's requiring payment of the taxes would have to be paid, and then ultimately it could be that the Supreme Court declares this unconstitutional, and now we have a big issue with people having to be paid back and all of that. And as I point out here at the end, it's really likely that we're not going to know what's going on until the state Supreme Court weighs in, and that could take anywhere from this next year to well into 2023. So the other major tax that we've got this year, of course, is the long-term care insurance tax. And this one's also in limbo, but for slightly different reasons, and with some, at least some certainty coming up fairly quickly of where we'll stand, at least for a little while. Let's see here. Sorry. Again, I think we all know the basic provisions. The idea is that employees are subject to this income tax, this payroll tax that will be withheld by employers, paid over to employment security. And then the idea being that in a few years, there will be a benefit where Washington residents who have paid into the program would be able to get some coverage, some payments for long-term care. There is an exemption that we're going to talk about here. Employees who had private long-term care insurance prior to November 1st of this last year are able to opt out. have to apply to opt out, and that application period goes through the end of this year. Actually, you have to have already had the insurance back on October 31st, but you actually have a whole year to apply. Also really exempt, and this doesn't come up very much, is anybody whose earnings really comes through self-employment, K-1s, things like that. So really this is a tax that only is on W-2 employees generally. Now, this was, honestly, this is the first tax of its kind in the country. A lot of people are watching Washington to see how this would work, and it was well intentioned. This had significant support from both parties. The idea being that Washington consistently has had significant expenses because people are uninsured later in their lives. And the idea being, well, if we create this sort of program, we could provide benefits to people while also hopefully reducing the costs, frankly, to the state of Washington. Problem is that ultimately the act as passed has a huge number of issues that either weren't really thought through or just it just has torpedoed a lot of what the intention was. And there are a bunch here on the screen. One of the most significant is, and this is the first one here, and a lot of people may not realize this, but state constitution generally requires that any monies of the state have to be invested in very secure investments. Generally think things like T-bills. I mean, where you're earning 1-2%, whatever it is. And in order to get around that, like the state pension funds, there has to be a constitutional amendment to allow for a fund to actually invest in the marketplace. When they designed the system, the whole idea of the plan, it was based on actuarially the idea that they would be able to get market returns on the money that was put into the plan. To do that, they of course put a constitutional amendment on the 2020 ballot, which failed. So just from the start right now, actuarially, the plan would have some significant issues. It is not, instead of earning 7%, it will earn 1 to 2% or something, at inflation or less. The definition of Washington employees includes a whole bunch of people that live outside of Washington but work in Washington. This includes people in Canada, Oregon, Idaho, etc. And because the definition of Washington, in order to be able to get benefits, you have to be in Washington and a Washington resident. All those people will pay into the tax but never see any benefit. There is a lawsuit outstanding alleging that this violates ERISA. I'm not going to talk too much about it. It does have quite a bit of merit, but as of right now, there's going to be some other changes that I think is more of interest to us for the moment. Again, here's a bunch of these issues. I would note that also, if you leave Washington, you may have paid in for 20 years. If you leave Washington, you retire to Arizona, you don't get any benefit. And there's no cap on the salary that is subject to the tax. So if, unlike Social Security, right, where there's a cap, I think it's 147,000 or something like that this year, there's no cap in this. So if you earn $1 million as a W-2 employee, all of that would be subject to this tax. And one of the, a lot of these issues kind of combined to create one of the really big issue, because there's one thing that the act doesn't have is kind of a continuing check on whether or not somebody's really has really maintained private insurance. So you opt out. Once you opt out, that's it. There's no further check, no further requirement or anything else. And that combined with no cap on your salary, on the salary, and all these other things, has led to hundreds of thousands of people trying to opt out. And perfect example of this is up here. Really what we're looking at is a lot of people who are in the tech industries who are much younger than people who would ever normally try to get private long-term care insurance, which normally people in their 50s might try to get. These are people in their 30s because they recognize that, hey, if I pay $1,000 now, I get a policy, I get exempt, and I don't have to pay under this tax. The more than 450,000 people so far have applied to opt out of the tax. That is a lot. So where are we at? Well, the tax did go into effect on January 1, but as I think everybody knows, the governor, at the urging of the legislature, directed ESD not to require payment by employers. The weird thing is, at the moment, because the law is still on the books, employers are officially required still to collect the tax from their employees. Now, politically, that's, if you are not doing it, this is one kind of situation where it's most likely going to be just fine, because there is a urgency in the legislature to pass legislation that will put a moratorium on the entire tax into 2023. And in fact, yesterday, 2 different bills passed in the House that will delay the tax to July 1 of 2023. Excuse me, those are now going on to the Senate. There may be some changes to the language, but I mean, the Senate is certainly going to pass these. The governor is going to sign them. It's pretty clear that this is going to happen in the next, it could be in the next couple of days. It might take a couple of weeks, but it's going to happen very quickly. There are other provisions in those bills that do address some of those issues that we were just talking about, and those may pass. The intention, though, of the leadership in the House, which in this case we are talking about the Democratic leadership, has been to put a moratorium on the bill, or excuse me, on the act, and then have the Long-Term Care Commission, which is this advisory committee that has been helping the legislature to review everything and then make new recommendations to the legislature, and then they can do kind of a comprehensive updating through into 2023. So at this point, it looks like we're looking at the long-term care insurance just kind of being in limbo for a lot longer, but at least no requirements for collection or paying over those amounts. Couple of other notes on the employment side, as we are now dealing with and continue to deal with COVID and the various regulations. As I think most people have probably seen, the Supreme Court recently suspended the mandate under OSHA for large employers requiring vaccinations. That doesn't mean they struck it down. What they've done is they've basically put it on hold, not allowed it to be enforced. It's going back down to the appellate level, and there will be, additional review there. There may be additional review up at the Supreme Court, and frankly, OSHA may revise its mandate and reword it or something to try to pass muster. But as of the moment, that the large employer OSHA mandate is on hold. Also on hold is the enforcement of the executive order for federal contractors. Now, this is based on different law. This is based on the federal procurement statutes, not OSHA. But this has been challenged in a number of different locations. but most notably, the challenge that has been in the district court in Georgia was the judge in the district court did agree to an injunction against the federal government, not allowing them to enforce this mandate. That injunction, the federal government appealed that up to the Court of Appeals for that circuit, the 11th Circuit. As of right now, the Court of Appeals let that injunction stand while preparing for an actual hearing on the matter, on the merits. And that hearing on the merits, it won't be until April. So that one is also in limbo at this point. But all of our Washington, Illinois requirements are still in effect. And I believe the most recent update for that was in September. And finally, as we think about this, here are some ideas of what you should be doing as employers, thinking about, if one of these affects you, if you're a federal contractor, you do want to at least take some steps or be ready in case you are going to have to meet these mandates. So you want to develop your policies related to this. You're going to want to get information from your employees on who's vaccinated and who's not, because you're going to have to track that. You do want to keep your employees informed. The contracts that have the federal mandate language in are, obviously that mandate language is enjoined right now, but you want to make sure that the contract, you're still complying with everything else. And then finally, on the employment front, we have had some minimum wage increases this year, both in the state and here in Seattle itself. The the Paid Leave Act went up, and the non-compete agreement earning thresholds went up. What I'm talking about there is until fairly recently, there are some businesses in Washington that would make all of their employees sign non-compete agreements, and that included, in one case I know of, pizza drivers. That the state has decided, and that's not appropriate for lower income employees, and really stopping them from being able to get employment elsewhere. So there is an earning threshold generally where below which the state generally will not allow a non-compete agreement to be recognized or be effective. And with that, I am complete. Done. Thank you.
Thank you, John. One of the things that I think has been most confusing for all of us has been the capital gains tax. Will there or won't there? How much? What qualifies? So I think you really gave us a lot of good information about that, and I appreciate that. That's been very confusing. The other thing that I think, again, and we did have some questions from the audience about this, was the this Long-Term Care Act. So if you just gave us simple, we know that you can't give us legal advice necessarily, but if you were just to give a good basic recommendation for most of us, is that to withhold or not to withhold?
I would have to say withhold. And the reason I have to say that, for a perfect example, is the state of Washington as an employer is currently withholding on its employees, because that portion of the law, there's no, it's in place. It's effective as of January 1. Practically speaking, if somebody doesn't do it, there's no, even under the governor's order, there's no penalty to the employers when they fail to pay over, and two, while nothing is certain, I find it extremely hard to believe that in the next few days to a week or so, we won't have this moratorium on this tax that will go into 2023. So employers that frankly skirt the law at the moment will at least avoid the overhead of having to have withheld tax and then potentially have to then pay that amount back to their employees.
I was wondering about that. So if you do withhold it, and if they do change the law, then you have to give it back to the people because it doesn't start until 2023.
And that's in the legislation that passed the House, that any amounts withheld are to be paid back to the employees, and there's no penalty or anything like that on the employers because the employers did what they were supposed to do.
Just all that record keeping that we have to do when there's
Or overhead.
laws that you have to follow, right? Yeah. Thank you so much.
Oh.
That was really informative, especially about the capital gains. From my perspective, I think people have a lot of questions about it. With that, I don't see any new questions coming through. I think we can wrap up